in my opinion, American Express has a nice blend between value and growth right now. We can see its performance over the last 5 years, 142%, compared to the S&P 500, which is only up about 90% if we zoom out. We look at roughly a 10-year performance, you're up, 80%, or excuse me, you're up from 80 to 317. That's a good performance, better than 200%. So this company has done well in terms of performance. If we look at PE, it's cheaper, significantly cheaper than the S&P 500. Your PE is about 22.5. The S&P 500 PE is about 30. So you're cheaper, you're significantly cheaper, and you've outperformed in terms of share price. Also, credit card companies, historically, very consistent. Year after year after year, you will get growth in revenue and earnings per share, assuming that the market consumer spending continues to go up. So it's a solid company. I think it's one of the better out there. It might be even up there with Visa and MasterCard. But we're going to be diving into all the things surrounding American Express in this video. So if you're interested, I hope you decide to join along and watch. Of course, when you're investing in a company, you have to actually understand what that company does. For American Express, you guys all know what American Express is. 99% of you watching know they're a credit card company. You've seen the commercials, this, that. So let's dive a little bit deeper. Let's kind of do a merger. I like to break down revenue of the company. I'm going to dive into some of the ways that they make their money. Primarily, when you buy from a merchant, when you buy from a store, they get a slight discount from them, or they get a slight portion of that money. That's where 60% of their money comes in from, roughly 58%, 61%, depending on the quarter, depending on the year, yada, yada, yada. So that's the majority. Of course, there's fees. If you don't pay it, they get interest. And there's a couple other ways they make money like that. And then they have some other services stuff, which makes up some portion, but it's closer to, 5 to 6 to 10% of revenue. So it's not a whole lot of it, but they do have their thumb in quite a few different pieces. But yeah, they're a credit card company that make money in all the ways credit card companies make money. We can see here the PE is 22.5. Forward PE is 20.5. So we are below the market, the S&P 500, which is at 30 PE and then roughly 24-ish forward PE. So we are cheaper on both fronts. If we dive a little bit deeper, first thing I like to look at, non-GAAP versus GAAP. Let's just see if these PE numbers are thrown off a bit. And they are slightly inflated for this year. I'm not sure what that is, but it's not super dramatic, so I'm not super concerned about it. But that tells us our PE numbers are slightly inflated. But that doesn't really matter, because going off of forward PE, well, it actually tells us, okay, the growth for next year projected is better than what it looks like. If you're going from 22.5 to 20.5, you're not really expecting that much growth. But it's actually a little bit better than that. We can see we're projecting roughly 14.5% for 2025. That's solid. That's actually really, really good. You would expect the average company to grow somewhere 10 to 12%, and that's what the S&P 500 does. Maybe a little bit less if you're looking at a value stock, and right now, American Express, where it's valuated, it's definitely closer to value than it is to extreme growth or anything like that. Revenue is a little bit more tame, 20% growth from 22 to 23, 9%, or let's just say 10, and then we're going to be flat for next year. So in my opinion, yeah, you should probably be able to beat on revenue here. You probably should. And if we look historically, they beat pretty consistently over the last year at least. We're not going to look years and years past, but usually if you beat for a full year, you generally beat. So maybe if we're being a little bit optimistic, we say forward PE may be closer to 20 or 19, just because they have a history of beating, but doesn't really matter. Let's take a little bit of a look at the balance sheet and the income statement. So we can see total assets increasing, debt is increasing. It's really not, it seems like a very high amount. But when you look at just how these companies operate, if you look at MasterCard, Visa, you're going to see very similar levels of debt. It's just how these companies are run. You need vast amounts of capital. You're always loaning this out and that out. That's just how these credit card companies work. That's how this works. So nothing super concerning there. It's actually pretty standard. We can see one thing that does look good. They had a particularly poor year in 2020. Shouldn't be that surprising. People generally were not spending a whole bunch. That kind of happened more towards the later 2020, 2021. But either way, they had a poor year in 2020, at least in terms of on the books earnings per share. So no, they haven't quite tripled, because if you look from 2019, they were higher, but still a company that's done very well. They've grown well. They've roughly doubled since 2019, so a 6-year period, which is good. The biggest difference between, so if there's, let's say, the big three, in my opinion, there is a big three. It's MasterCard, Visa, and American Express. There's a couple of differences. One, American Express PE is significantly lower. They're not quite as big as the other two, at least not historically. They're kind of joining that. In my opinion, they have joined it. Not everyone agrees with that. But the biggest difference, another key difference, is MasterCard and Visa. If you were looking at a 10-year period, they did better from that 2015 to 2020 range, and then have done slightly worse, at least in terms of share price, not in terms of company performance. Have done worse in the latter half, let's say middle of 2020 to 2025 now. And the American Express is inverse. They did worse from that 2015 to 2019 range, but since 2019, certainly since 2020 when they had lows, have done just incredibly well. So that's a key difference, primarily. But yeah, there's nothing concerning here. They're growing relatively fast. Of course, not as much as a growth company, in the sense that, okay, we're gonna be able to go up 100% every 5 years or something like that. But there's more stability here. These credit card companies are, if you just look at the consistent year after year after year after year after year after year growth, it's just very, very impressive. And you see it. We saw it earlier. We're expecting it to continue. And I wouldn't be surprised if they continue to actually slightly outperform the S&P 500, although we're going to get into some projections later. So I always like to, in these videos, 90% of these videos, I like to cover the historical PE from this website. I think it has good UI. One negative is it has a bunch of ads on it. It kind of looks a little messy in the video. However, we can probably be pretty sure that American Express at least has decent targeted ads, considering we're talking about American Express, we're looking at it, and it gave us not one, not two, but 3 separate American Express ads. Maybe that's happened in one of these videos before. I haven't noticed that. So that's kind of funny. Usually I like to stay on track in these videos, but that is really kind of interesting. So whatever you think of that, you can see share price has shot up. Earnings per share, consistent growth. So what, back in 2015? Yeah, there we go. That's almost a decade ago. This is actually closer to a decade ago. So we were at 5.56 earnings per share. Now we're at 13.5. So that's what, not quite 2xing over a 10-year period, but you're still doing well. And certainly for a stock that, you don't expect it. It's not like a tech company would expect it to do this performance. One thing we can see though, so we can see these 2 blips here. We can see because share price was fairly stable, there was probably something messing with the actual PE, and behind the scenes they were probably earning just as much. It wasn't like the company was doing terrible, because when we see spikes in PE ratio like that, but share price is relatively flat, we saw a little bit lower. We saw a little bit lower heading into this period. We can see a little bit of drop in share price, but not a huge deal. One thing, so earnings per share for a company like this, it's good. You've grown it fairly well. Obviously, when you look at something like a Microsoft, not going to be as impressive, but we aren't expecting our American Express to grow that well. We understand we can't be 100% tech, but we can still get good value and good growth out of stocks that maybe don't have that crazy high ceiling or likely won't grow maybe as fast. But still, PE ratio, we can see 15, 15, 14 in that range. Okay, 15. Okay, we're a little bit higher after this. Maybe in the high 15s. We'll go back lower to 15, 16, 18. Okay, now we're in the 20s, right? We're 22, whatever it may be. We've seen an acceleration in share price, and we have ran up. We've ran up from 150 to basically 300. So we've basically gone up 100% since 2023, late 2023. That's a big run up, but we have grown earnings per share relatively fast. And it's still not expensive. If you categorize it with the Visas and the MasterCards, and you want to own either Visa, MasterCard, or American Express, this is still the cheapest one, and it's really not that particularly close. I believe MasterCard and Visa both are at least in the upper 20s, if not low 30s, mid 30s. American Express, I'm pretty sure American Express, sometime last year I was looking at, was upper 30s. So you're still relatively cheap. Now, I'm not trying to sell this to you. It may sound like I am, but I'm trying to explain to you why I like this stock and why I personally do own this stock. I mean, I owned it. I'm not buying necessarily at these prices because I already got in for what I want at slightly lower prices. But if you don't have any exposure to credit cards and you want some, American Express is, if you're looking for the value blend of it too, I think it's probably the best. And yes, PE is higher. And if it goes flat, U.S. consumers spending goes flat, things like that, yeah, you're probably going to see it taper off, maybe even, recede a little bit. But it's not like these are crazy, crazy high prices. Certainly when you have a company like we said, when we're looking over the 5-year period, has outperformed the S&P 500. Every company has unique risks and advantages, and it's important to weigh them look at them and actually understand them before you invest, so you actually understand what you're getting into. Credit card companies are interesting. They're incredibly consistent. I've talked about this in the video. They are. They grow and grow and grow. People use more and more credit cards. It's just how the cookie crumbles. Even though certainly with American Express, like I said, we're cheap. We're 20 PE. That's relatively cheap. Certainly cheaper compared to the S&P 500. It's still not going to hold up like your average value stock in a recession. At least you would expect maybe something like a Vici, right? You're going to get your 6% yield with Vici. It's going to go down when everything's going down, but it's going to recover fairly quickly. Or like in a utility company. I think because when there's a recession, people spend less money. People spend less money on credit cards. Consumer spending's down is generally going to hurt credit card companies. And people understand that. So there isn't much of a recession hedge, which is something we look forward to with value stocks. Right? And I'm of the opinion that American Express has a blend of both. It has the growth in the sense that it's growing fast, but also has the blend of value because we're significantly cheaper than the S&P 500. So that's an inherent risk that you would assume would be an advantage, but really isn't there. Like I said, these credit card companies are so consistent when consumer spending's up, which it is year over year when there's no recession. American Express is going to do well. I think also, certainly when you look at their performance since 2011, they've mimicked the S&P 500. If you go further than that, since 2000, they haven't. But that just shows that, in my opinion, leadership has done a very good job. Certainly in the more recent years, they've done a very good job. They're targeting generally high credit. That's kind of their niche. They don't do a lot of low credit consumers. So I think that's relatively smart. I mean, when you look at these companies, there's not a whole lot of crazy. Right? There's not a lot of competition, right? You get a wide economic moat. You generally do. There's a couple. You don't have like sole hand around the throat of the entire market like you do with something like a TSM or an ASML or something like that. You just don't. But there's not 8 bajillion different credit card companies. There's basically 3, really. In my opinion, there's a Discover's there, but whatever. I don't see it. I don't think they're particularly well run, in my opinion. If you do, that's okay. But I don't see it at this point. But they do have a fairly wide economic moat just because there's not a lot of competition. There's some, but not a crazy amount. Schwab thinks they're going to continue to do well. They agree with me. They do not always agree with me. So I'm happy they agree with me here. If you haven't picked it up, I like American Express. I do. I've done well on it, particularly recently. I don't think it's like screaming by like it was a couple months ago, but I still think this is probably a solid company to hold for the long term. And Schwab reiterated 4 days ago they think this company is going to continue to do well. Now, if you guys made it this far in the video, you either really like my content or are really interested in American Express, and we're going to do a little bit of forecasting for the company. I'm not a big share stock price forecasting guy. I just don't. I like to say, okay, I think this company's going to do well, but I don't like to say, oh, the share price is going to be here by then. There's too many factors, too many things like that. However, I think American Express is well positioned. I think they're well positioned to probably roughly match the S&P 500 over a 5 to 7 to 10 year period. I think the leadership has proven that they're pretty good. I think they've put themselves in the class with the other two. I've said that numerous times throughout this video, the Visas and the MasterCards of the world. I think they're solidified in that, in my opinion. And you could actually see if their PE inflates to near those prices, you're going to get a significant increase. Now, in my opinion, I do own Visa, but I own it from, the long-term perspective, because I actually think a little bit over 30 PE for credit card companies is a little bit ridiculous. But if American Express mimics that, you'll probably outperform the S&P 500 over 5 to 10 years, because that means that if they're over 30, that means they're definitely continuing to do well, or the S&P 500 is above 40 PE. But that means they're continuing to do well, and then you also get that inflated PE with it, because it's not going to inflate if they don't do well. And if you get that inflated PE, you're getting 33% for free in terms of share price, just inflation for valuation. So you're probably going to outperform if that's the case. But if not, I'm not particularly concerned. I still think this company is going to be able to do well going forward. I do. I think they're well positioned. I think they're, like I said, roughly matched. So somewhere 20% above or 20% below the S&P 500 performance. If you made me, gun to my head, say it's either gonna do better or worse, what would you say? I'd probably say better, but it would be very tough. It'd be very tough because at the end of the day, with value and non-tech stocks, you're competing with tech, and tech's always going to outperform. However, there's still a lot of laggers in the S&P 500, things like that. And in terms of, okay, we're balancing, we're not going to be 100% tech. And if you're not 100% tech, in my opinion, this is one of the better stocks, non-tech stocks that you can have in terms of long-term share price appreciation. That's my personal opinion. I own American Express. I don't own a crazy amount, but I like it. I like it as a company. I think it's going to continue to perform well. If you made it this far, I know you at least enjoy this a little bit. I appreciate when you like and subscribe, comment, all that sort of stuff. I just appreciate you guys for making it this far anyway. So I'll catch you next time. Thanks for watching.